Hello and welcome to the headline segment of Making Sense of Markets for the fourth quarter of 2017. My name is Matthew Carvalho, Director of Investment Research at Loring Ward, and I'll be your host for this segment. The headline segment is meant to put some perspective around topics that you may be seeing in the financial press and provide context for how those issues may impact a long-term investor. We'll start by reviewing some headlines and the performance of the S&P 500 last year. Now, we started off the year with some rather pessimistic headlines, such as this one on February 22nd, which read, 10 reasons to be nervous about the all-time high stock market. It was followed up just a little bit later in March by another one that we saw really throughout the year, in which investors perhaps should be worried about stock valuations reaching their highest since 2001. Well, the year went along, and a little bit later we figured out that neither war nor politics can stop this stock market steamroller. We did see a rather comical headline towards the end of the year in this report from Quartz, which read, for 4 years, Citigroup told clients to sell when it really meant to buy. Basically what was happening here was Citigroup had a technological malfunction where the results of its analyst reports were being relayed incorrectly to their brokers and clients. So an analyst would write up a report saying a company was a buy, but the communication to clients in a website would say to sell, and vice versa, for 1,800 stocks over a 4-year time period. Now, what's even more troubling than the actual bug in their system was that the error did not seem to matter to actual clients or the performance in those client accounts. The ratings of these analysts was essentially worthless. And we finished up the year with one headline that's relatively familiar now. December 31st, valuations are stretched, central banks are taking away the punch bowl, and fundamentals look long in the tooth. I was elated to see the line long in the tooth in that Russell report because just last year we had created this slide showing that term seemed to make its way into the headlines for basically every single year since this recovery has begun in 2009. To me, this shows that people always try to predict the directions of markets, but often with very little success. Now to pivot to something else frequently in the news today. In the next few slides, we're going to discuss blockchain technology and the cryptocurrencies that we're hearing so much about. We're going to focus on them more from an investment perspective, as there are numerous articles or videos which can give you a much better primer on the actual workings of them than I can in the next few minutes. At a very high level, blockchain is a way to maintain a public ledger of digital information which can be distributed but not copied. Blockchain technology has created the backbone of a new type of internet. Information held on a blockchain exists as a shared and continually reconciled database. This is a way of using a network that has obvious benefits. The blockchain database isn't stored in any single location, meaning the records it keeps are truly public and easily verifiable. So to go through a real-world example, imagine that the next time you went to buy a house, you didn't have to go through the onerous title insurance and escrow process, because you would be able to verify that the seller did in fact own the house you were looking to buy, and that you as the buyer did in fact have the deposit for the purchase. The blockchain can validate the exchange without having those several layers of intermediaries. This, at least, is the hope of many enthusiasts, that transactions as large as home purchases or as small as buying a cup of espresso in Argentina can be done seamlessly and efficiently between the two parties involved. Blockchain is the technological innovation, while Bitcoin is a means of exchange. Bitcoin came into existence as the world's first decentralized digital currency via a single white paper penned by a pseudonym Satoshi Nakamoto in 2009. Bitcoins were created to act as an incentive for individual computer nodes to expend the effort necessary to update and maintain the blockchain. Why has this digital currency, which very few people are actually using, garnered so much attention lately? Well, remember how the entire world was going to adopt the Japanese way of doing business in the 1980s? Or how the dot-com stock seemingly had nowhere to go but up in the late 1990s? Well, both of those were previous examples of extreme price increases, experiencing gains of over 500% over a matter of years. But now take a look at just how dramatic Bitcoin's rise has been just over the last 2 years, and it's easy to see why it's garnered so much attention. With Bitcoin, much like gold, it's extremely difficult to know what the value should be. There are no cash flows, dividends, or future payments that you can estimate the present value of. And there's also enormous regulatory, cybersecurity, and price volatility associated with the currency. Yet gains like we've seen lately are going to attract a lot of attention and interest. With such a rapid increase in value, and upon fielding frequent inquiries on its merits as an investment, at a recent team offsite at a pottery store, I put my lowly art skills to work on a Bitcoin piggy bank. I just loved the irony of a physical piggy bank for a digital currency whose value is in rapid flux 24 hours a day, 7 days a week. Looking back to the headlines for the quarter, a perfect illustration of this fever pitch came in this Bloomberg article entitled, "The Stock Market Has Gotten Out of the Casino Business," with the subtitle, "This might explain why volatility is so low. All the wild speculators have shifted into Bitcoin." Now this is a fantastic title and really highlights such an important behavioral concept, the fear of missing out. Hindsight is 20/20, and while we all wish we had acquired several hundred Bitcoin when it was trading at mere pennies, the same can be said for Tickle Me Elmos, Beanie Babies, or tulips at different points in history. And to top it off, the actual ads at the bottom of that Bloomberg page included one which was purporting that you could quit your day job in order to trade Bitcoin, and the other which was saying, "Beware, the great meltdown is coming." These perfectly encapsulated the range of emotions around Bitcoin right now. Cryptocurrencies like Bitcoin, which aim to leverage the benefits of this new blockchain technology, are going to be pretty exciting. But as with any new technology, the risks are going to be high. Think about trying to make investments in other industries based on the foresight that they are going to reap huge economic profits down the road. Picture cell phones 15 years ago and placing a big investment in Nokia just to watch it dwindle while smartphones took over the world. Or being early on the social media scene and backing MySpace. In fact, more than 20 search engines looked to catalog the evolving internet before Google came along. Predicting the future of technology is hard enough. Predicting who will capitalize on those changes is even harder. Just as we wouldn't advise investing in any one stock or IPO, investing in one currency or ICO is extremely risky. We just don't know if Bitcoin, Litecoin, Ethereum, Ripple, or some other currency that hasn't even been invented yet will have a meaningful impact in the future. I've spent about 25 hours of reading and research on this topic so far, and I still struggle to have any kind of an idea where it's going to head. I've also gone through the account opening process at a few sites, and let me tell you, it really is the digital Wild West of investing out there. And you'd want to have a very good understanding of cybersecurity and the risks involved before placing a single dollar into them. And even then, a colleague recently mentioned a great idea, that any dollars that are put in at this point should be considered tuition to the school of capitalism, because sooner or later you're probably going to get taught a lesson. Now in the meantime, when we think back to the underlying blockchain technology, well, this isn't a secret to existing companies. Last year, big announcements came from commonly held public companies like UBS, Toyota, and IBM. And in fact, just 4 days into 2018, the term blockchain had already been mentioned 110 times in company press releases. The fear of missing out on the enormous gains will not go away anytime soon. There's always going to be an asset or a part of the market that will look awfully appealing, but investors should keep in mind what they are investing in and why they are invested in it. For many of us, while we didn't see the 1,000+% returns in our portfolios if we had only held Bitcoin last year, we likely did see positive returns that were likely higher than what our financial plan had estimated, and so we may still be ahead of schedule. The start of the year is always a great time to review your financial plan with your advisor and see if any updates are needed based on any changes in your own personal financial situation, not whatever cryptocurrency is in the news that day. Additional commentary can be found on the Making Sense of Markets portion of Lauren Ward's YouTube channel.